The NASDAQ made brand new all-time highs today in the cash market as investor optimism increased on two major issues. The first clearly being the ceasefire announced on Monday, but the more sneaky one is Jerome Powell's testimony over the last 2 days, basically revealing that major rate cuts, lots of them, are on the way based on concerns about the labor market. It would seem to me that so long as these next key levels hold up, the S&P 500 with this backdrop should play catch up and make a new all-time high as well. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY daily time frame chart, and as always, let's start with the basics. What do we see here from an overall trend perspective, and what does the daily structure look like? Well, since the China gap, this is the last major higher low which was supportive over the daily 200 SMA. From there, we know that this was a soft higher low, and this was finally a firm higher low because the hourly trend did flip to down in this pullback here, and we know that the pullback was coming from the highest high in the trend count. Now, I think we can all agree that via the gap up on Tuesday, the gap and go, and today's morning open on a gap up, it was not a gap and go, but we did open higher, we are producing a brand new higher high in the daily trend count, which means that even if the market were to pull back, if it moved in the downward direction, so long as the daily chart produces a higher low above this 595.15, I would still classify the daily trend as up. So hypothetically, if we're looking at this chart, the market could pull back all the way to close the gap from the Tuesday morning session, retest something like 599.25, and if buyers were to step up here, I would certainly qualify that as a higher low in the daily trend count, and it would remain in the upward direction. That would be bullish, although it may look like the market needs to move lower for that to actually take place. Finding the next higher low would be the next key entry point if the market's going to produce the pullback and then make the full rotation into the all-time high. So that's one situation that we can possibly look for. However, if we take a look at the actual daily structure, the candle from today's session, let's just think about what this actually represents. The market opened right at the highs of the previous day's session. It tried to move higher in the upper wick, and then it actually made a low inside the midpoint of the previous day's range. Where did the market close, though, is the key question. It closes over the previous day's close. Did the market get anywhere close to attempting to close this gap down below? The answer is no. So if I'm thinking about the daily structure towards this highest high, yes, we understand that from a location perspective, it's okay if the market pulls back and yields this higher low, but there's nothing about the daily bar that would be overly indicative of a massive reversal that's about to be underway here in the market. And of course, we will have key levels to use if the market's going to close the gap. The first step would be that if this previous area of resistance is no longer going to act as support, which you can clearly see that's exactly what's happening here in the lower wick of today's session, if that's no longer going to act as support, then fine, we will trade for the gap close as a short scalp, and then we will watch very closely as to whether or not buyers step up on the retest of 599.25, which as we know comes from a more firm level off to our left. And what we could do actually here is just continue to look off to our left. It's this previous low which then acted as resistance from back over here. So as we're looking off to the left as well, I think it's worth acknowledging that the next upper level is the opening print of this larger breakdown bar from over here at 610.25, and then we're really talking about the all-time high in the S&P 500. As we mentioned in the intro, and as you probably saw today, the NASDAQ 100, so the QQQ, did go on to open on a high, new all-time high gap up. So in my view, it's sort of, the primary outcomes for the S&P would be any consolidation over 604.75 is the next bullish build of the market structure ultimately, seeking some sort of next breakout over today's high to get that clearance into the all-time high. And once again, if the market fails back down into this previous range, so under 604.75, I wouldn't just be short under the level, I would look to short through the gap close, and when and if the gap closes, I would still maintain the bullish stance to say, okay, can we get long here? And then can we get long here on a similar situation to the upside? I'll put a little green dot as to where the long becomes really attractive. A hold over 599.25, a gap fill reversal. Or if that's a little bit too aggressive for you, you could say, okay, I'd like to see the higher low step up And then I'd like to see some sort of continuation over the previous area of resistance, which is now proving itself as newfound support. Those are two potential entries if we're looking for this market to move in the upward direction. Of course, the alternate, which we already went over, is just sort of consolidation over 604.75, which then seeks follow through over today's opening print towards the all-time high, something along these lines here. And of course, it would just recognize that as a bull flag on the daily timescale. Let's get a little bit more granular here. And well, before we do that, actually, let me also point out that we are technically at the upper edge of the weekly expected move. Now, as we know, the weekly expected move is set on the previous week's Friday. So is it possible that the market can move higher than this? Of course it is. If you actually take a look at the options chain right now and look at the Friday expiration contracts, the market's still pricing in about $5 of movement that could be up or down based on the options premium right now. So if we go back over to the chart, I mean, $5 on top of where we closed, let's just call it 607, brings us to 612 on the upside, which is easily starting to scratch at the all-time high. Is it extended through the previous Friday's close weekly expected move? It is, and about 68.1% of the time, the market will end up closing inside of this box, but it is not an end-all be-all area of resistance. So if the market can sustain price action over on the daily timescale 604.75, I would maintain a bullish stance seeking continuation to the all-time high over time. If we do get a pullback underneath that level, I'm only willing to short the market for a scalp through the gap close and then seeking buyers at 599.25 as the key next area of support that needs to step up. Remember back to where we started here, we have lows, we have a soft higher low, we have a firm higher low because the hourly trend was down. If we were to break and close this gap, I have to imagine the hourly trend flips to down, just considering where we've closed as of today's session. This is the next ideal daily higher low. Let's take a look at the hourly time scale, and I want to talk about a couple of little nuances with price action here. The first thing to call out is just on the Tuesday morning gap up, the market hardly budged into the gap. So what's the key takeaway here? If we had stronger sellers on a gap up open as we were headed straight into resistance, then stronger sellers should have taken the opportunity to reject off of this previous known area of resistance, offer a full gap close, and then attempt to get price acceptance inside of the Monday range. Obviously, that did not take place, and as evident by the lower wick of the first hourly candle from Tuesday, there was a very short-lived snap to the downside, and then there was a very grindy session, really, intraday. It was a slow grind to the upside, but all day, just grind, moving in the upward direction with no regard for this previous area of resistance. So once again, the takeaway here is what types of participants do we have in the market? We don't have stronger sellers. Even if you're still hesitant to say, oh my God, there's no momentum bulls in this market. This was a slow grind. I would agree with you. It was a very slow grind, but I think we can both agree, even if that was a slow grind and momentum buyers aren't here, there really aren't stronger sellers. And for that reason, it would be very difficult to maintain any sort of short stance on this market. So the one thing to call out is that we did look above and fail back into the Tuesday range as of today's close. And if we consolidate in this little range here between 607.50 and 606.25, what is the level? 606.25, then I would consider this a look above and fail on the bar by bar count. Remember that your daily bar from Tuesday looks something along these lines here, and your daily bar from today's Wednesday session looks something along these lines right here. So if the market is spending more time inside of the Tuesday range, it's failing to accept outside of the Tuesday range, then ultimately the short trade could perhaps be a quick move, and this is like a scalp only, again, underneath 606.25 to get into this zone down here. Now, my preference is to not even look for that trade as a short. I would just understand that if the market breaches 606.25, you're still staying inside of the Tuesday range here. However, if we can support over this 604.75, which is very close to where the lower wick of the mid-afternoon liquidation break took place too, I would be more interested in this. So we get consolidation for bear flag, right? Look above and fail on Tuesday high. We Brigade bolt underneath. I would avoid trying to short that, and I would be much more interested in one of these. If we could produce that inverted head and shoulders, some kind of higher low, you can look below 604.75, sellers fail, buyers accept back above, I'd be way more interested in looking for that long to retarget the equal highs here at 607.50. So that would be a top priority for tomorrow perhaps, or maybe even Friday. If the market just opens in here and Brigade bolts back out of Tuesday's range, that's where we're seeking the upside move into, again, that 610.25. If the market starts to find some acceptance, so let's say we open in this range, we start to find some acceptance underneath 604.75, the only short trade that I'm interested in is this right here. And I'm not overstaying my welcome by any stretch of the imagination. We're looking for a quick scalp under 603.45 into the high of the Monday session at $600.50. As we've already described, stronger sellers are simply not here, and we'll see further evidence for this in the supporting evidence charts. So this is a scalp. We do not overstay our welcome. When and if we get down here, I know we talked about it on the daily, but I just want to reinforce it once again. If we support over 599.25, this is a long to get back to here. And then beyond that, if we can accept back over 604.75, that's also a long. So let's go ahead and throw on the green dots for where those longs are, right here and right here. Very similar to the pathing that we do every single morning for the pre-market prep here on the channel live at 8 o'clock, right? If you've come out to the show in the past, you know exactly what I'm talking about. So these green dots, really attractive to the upside. There's only one red dot. There's only one short that I'm really interested in. If the market opens on a sort of, let's just say that overnight, there's sort of another stage and wave of euphoria, I would not be as interested in trying to buy the market on a gap up and chase it into that 610.25 mark. Let me just do this so you can see the 610.25 level. I'd be less inclined to chase it here, and I would be more open-minded to a pullback that then comes back and retests something like 607.50 for a long opportunity off of that, right around in here. So if we gap up, a little extension to 610.25, not chasing it there, but then looking for the re-entry long on a deeper pullback to 607.50. So I think that's pretty comprehensive in terms of the different situations and scenarios that I'm personally looking for. Of course, if we were underneath 599.25, we do have to acknowledge the fact that the ideal daily higher low is not holding, and below that level, unfortunately, I would really maintain a little bit more of a choppy stance on the market in this box down here. We know that we've been trying to get out of this box for a very long time. We've finally done it. I would say it's probably more bearish, right, if we were to get back down underneath that 599.25, but we have to take the market one step at a time. The next major bear trade from my perspective would be under that 595.15. Why? It all stems back to what we talked about on Saturday, which was the look above and fail on the weekly chart. If we take a zoom in on this, remember that we had, and this just looks crazy with the levels like that. Let's do something along these lines. Let's straighten this out a little bit. Oop, come on, think or swim. Play nice with me. There we go. Remember, we have the 3-week balance range here. We finally closed back in it. In the Saturday video, we gave a number of reasons why I didn't think the market was actually going to go lower. But this, like, if we were to get back below that again after taking out these wick highs, that has to be a red flag. Has to be a red flag. I would be expecting a weekly pullback at that point for a potential higher low into the China gap close, which sort of is like the final point I'll conclude on for the market here, at least the S&P 500, before we jump into the internals and the market profile. If you just think about what unfilled gaps represent for this market, the fact that the China gap has not filled is still an indication that stronger sellers are not present in the market. The fact that this gap remains partially unfilled, stronger sellers not here. If this gap doesn't close whatsoever, you need to carry that forward in your narrative that stronger sellers simply aren't doing what they should do. Stronger sellers, that's like Sally sells seashells by the seashore. Stronger sellers should, in theory, be looking to close that thin structure, should be looking to navigate through this area of virtually no transactions, right? And the fact that it's not happening just continues to reinforce this idea that I've probably sounded like a broken record on for the past 5-10 minutes. Stronger sellers aren't here. If we go take a look at the market internals, what do we see? So market internals, if you're not familiar, check out the video tutorial in the top right-hand corner. What do we see? Today, we actually did end up closing market on close. There was this thrust to the downside underneath negative 300 million. If we look at the net flows of the week, they're still technically positive, though. The one thing I will point out, which we talked about a little bit in the group, is if we just maximize this for a second, notice that the breadth ratio was actually around -2 all day. The one thing that I guess we can bounce back over to the Spider's Cash for just a second is you probably saw online quite a bit about some of these distribution days down here. If you take a look at the high volume days, they tended to be a majority red days. Well, technically today, right, compare the daily bar volume. It's actually quite low, as a matter of fact. Compare that to what you have on the volume flows at the exchange level. It's not adding up. So are people really aggressively distributing the S&P 500 on this gap up this morning? Selling, it could be another term for that. Again, it doesn't strike me as like, oh my God, let's just unload everything up here at the highs. If that was the case, then again, you probably should be aiming for a gap close already, or it should have been happening on the Tuesday morning open. It should have been happening during today's session. It just wasn't the case. In my view, it's that longs are still acting a little bit timid up here, and I think for good reason, right? You don't want to chase the move at the tippity top and ultimately, position yourself at terrible trade location. The most appropriate thing for longs would be a clear and well-defined pullback off of this 60475 mark from back here, or a very well-defined gap fill reversal for the daily higher low, and then we sort of move from there. Stronger longs can establish a much more meaningful position, right? So getting back to the market internals and what this all means, basically, I don't see this as like a major threat. We'll take it at face value and say, sure, volume flows were negative. If you look at the advanced decline line, we were not in trend lower zone, but we were definitely below the 1,000 mark for a majority of the session. If you look at the index score, notice that this is completely flat. Index score measures the 30 most important data points for the S&P 500 as measured from the opening print, not the prior day's close. So to see this so flat all day, basically stuck at the zero mark all day, hardly getting negative, once again, not really an indication that we have stronger sellers stepping up. If this was going to be an Armageddon, you would have seen something that looks like this, and oh my God, the index score is sitting on negative 20 all day long. It was not the case. If you look at the cumulative tick as well, hardly getting negative. I mean, in the morning session, the tick was so compressed and so tight to the zero mark that it was very difficult to even say anything constructive about the broad market other than, hey, this looks and feels mostly like balance, not aggressive selling. So in my view, the internals do not really support the idea or narrative that stronger sellers are participating in the market, and that's sort of what we were talking about on the cash market anyways. If we jump over to, let's grab our market profile for the ES. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. What do we see happening with value? Right, here's value on Monday. Tuesday's gap up certainly brings value higher with the point of control. Notice that today's session, the value is completely inside of the previous day's range. So did value aggressively make a move in the downward direction? The answer is no. Did the point of control aggressively move in the downward direction? No. It's actually, if not the same, slightly higher. Let's hover the cursor there. Slightly lower. Geez, might need to get the eyeballs checked. That one's on me. But you get my point, right? It's not like sellers are really driving price lower for a trend day. This seems more like price digestion of the move higher that we've seen via the gap up on the Tuesday, Tuesday morning, headed into that Tuesday open. If we take a closer look at the high of Tuesday, I would just sort of point out, I guess there's a little bit better excess than I was envisioning. To me, when I was zoomed out at least a little bit, it looked like we had lack of material excess, but we do have decent excess there. If we look at the lows, plenty of excess in B period, plenty of excess in I period. Look at the volume taper here on the volume profile. So are sellers really getting bold towards the lows? No. And I think that this totally aligns with everything we've talked about so far. What about the highs on today's session? Yeah, a little bit of lack of material excess here. You only have one TPO of excess, which probably turns into two if we zoom in a little bit tighter. Yeah, 2 or 3. So still, given the nature of the range that the market's been trading recently, I would not call that a complete auction at the highs. So if that needs to be repaired, we should be looking for a move through that high. Generally, this still supports, in my view, that the market is still maintaining much more of a bullish edge, especially in our S&P 500. Speaking of bullish edges, let's take a look at the NASDAQ brand new all-time high. Let's go to a daily time scale, and let's see what we can see. Let's zoom in on this. Let's make it easier on the eyes, and we'll get into the same pathing ideas, any nuances, and things we should carry forward. So daily trend is what? Lows, higher lows, soft higher low, firm higher low, brand new higher high in the trend count. So the trend is up. The candle structure looks very similar to the S&P 500. However, you can see that we did end up closing just a hair over the prior day's range. We did close a brand new all-time high here over 540.80. So that's bullish. If we take a look at where we are relative to the weekly expected move, once again, we are extended through it, but it's just a suggestion from the options market. If anything, here's something that you could potentially carry forward, the concept of dynamic hedging. If you're outside of the weekly expected move and market makers are aggressively, in theory, if they've sold calls up and over the expected move high, right, then technically by selling calls, they're net short delta. If they need to neutralize their delta, what do they have to do? They have to go out and they have to buy 100 shares per contract that they sell of the underlying. So technically, if we start breaching this to the upside and market makers do need to kick in dynamic hedging, then buying should beget more buying. That's sort of where you get into a little bit of gamma squeeze territory. Now, I'm not going to explicitly call this a gamma squeeze, but it is a concept that could be in play the longer we spend outside of this week's expected move here. If we take a look at the options chain for the NASDAQ, you can see that we're still pricing in about $5.27 into the end of this week, the next 2 trading days. So let's just call it 541, plus we'll just call it $5 to be flat there. You're talking about 546, another new all-time high. Or if you pull back a little bit, excuse me, you're talking about 530 math, 536, right? Am I doing my math right here? 541 minus 5. My goodness, you never thought math was this hard, right? Yes. So in theory, that's the top of the gap, right? So hypothetically, this market has the possibility to go on to produce a brand new all-time high or remain over its key inflection point, right? We talked about the 604 level over on the S&P 500 cash here. If we just zoom back in for a moment, break that and do this. We talked about this 604.75. Your equivalent of that on the NASDAQ is going to be slightly different. If I do this, you can see it's here. It's 536.25. It's the top of the gap. It's the Tuesday low. If we could stay over that, that's your picture perfect ideal spot. And then really, if you want to split hairs with me, you could still yield a daily higher low over this level also at 533, which has been critical for the past couple of weeks, right? You can see it as clear as day on the hourly chart. If we take a look here, look at this. Look at this 533, right? Previous resistance, 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 acted as support, support, resistance here, supported above, resistance here, so on and so forth. If the gap closes, it's still a great spot for a possible daily high or low, pulling back from the highest high in the trend count, right? So that's all checking out as being well and good. You guys, it's the same game plan ultimately as the S&P 500. If we open over 540.80, I would maintain a bullish stance. We're over the previous all-time high. We're out of Tuesday's range. If we open under 540.80 inside of this zone here, we'll call it look above and fail. We'll call it for what it is. Perhaps there's a short for thin structure retracement under 539 to Brigade bolt here into 536.25. We will firstly reevaluate for buyers to step up off of that level. That would be the ideal hold. If that does not happen, and you could even say something like this, right? If you get here and then reject again at 539, then this is the next short, right? It's under 536.25 for a gap close, GC, down into 533. When we get to 533, as we've said, so on and so forth, right? It has to be the first look based on the daily chart. Let's just draw the full thing in. On the daily chart, if we're seeking a higher low, this has to be a long opportunity right there, right? So we're not just resting orders, blindly looking to long it, but if we can spot buyers at 533, that's a great spot for a technical higher low on the daily time frame. So that checks out. Let's take a quick glance at our intraday anchored view apps. You can see that we're getting confluence at both of the key levels. Is there any, picture perfect? Could not have asked for anything better. You have your anchored view app here around 536.25, and you have your anchored view app here around 533. This coming from the Monday low, this coming from the previous high from back 2 weeks ago at this point, right? So 536.25, 533, I've said it until I'm blue in the face. If we accept over 540.80, you're just trading blue sky territories, whole and half dollars, intraday levels that form. If we look at the market internals for the NASDAQ side of the market, what you'll notice is a little bit of a different picture here, where the NASDAQ breadth volume basically was not nearly as bad on today's session versus the S&P 500. Well, what do we know the S&P 500 is comprised mostly of? Over 30%. It's the tech sector. So as the breadth on the NASDAQ exchange as an entirety stays over the zero mark like that, not even getting close to negative 400, I would take that as a little bit of a more bullish indication. This advanced decline line did get close to trend lower zone, so we're not totally rainbows and butterflies here, and the cumulative build is a little bit more negative as opposed to flat in the S&P 500, so we'll sort of balance this out. The volume flows, the aggression, the magnitude of the selling was not nearly as bad volume-wise, but a little bit more bearish on the tick and a little bit more bearish, not a lot, but a little bit more bearish out of these two metrics here. Bottom line, I still do not feel as though this is representative of stronger sellers at the exchange level. Just unloading everything going to cause a massive panic attack for the market. If we pull back, this is a pullback that I would welcome. It's a pullback where I think stronger buyers can establish better positions away from the all-time high, not feeling like they're chasing it with much better risk reward. If you could risk this for reward back to the all-time high, fantastic. Continuing on into blue sky territories, awesome, right? So that's the name of the game here out of the NASDAQ. Let's take a look at the market profile for the NASDAQ side of things. And we can draw the same conclusions here, where value actually moved in the upward direction. Point of control was unable to close outside of the Tuesday session, but value was undoubtedly higher. Now, it was lower in the individual profile, which this brings up a decent or valid enough concern where if you were to break today's lows, right, say you open in range and break today's lows, any longs who are caught up in that value area, and remember that the value area is just 70% of where the day's volume transacted as distributed away from the point of control. If that's the case, then it's going to be easier to flip those longs late to the party basically to be underwater if you're below prior day's low, which is a pretty basic concept in technical analysis. Anyhow, if you break a previous candle's low, you should probably get some sort of follow through in that direction, right? So I think generally that is supportive of that. And all I would say is if you end up opening over the Tuesday high, I think this is worth calling out. If you're over the Tuesday high, where are you relative to the point of control? All of the longs from there are still feeling good. So I would not jump the gun on the short side if the market opens over that key reference point. So you could use Tuesday's high. In the NQ futures, we're talking about roughly 22,450. If you are using your QQQ cash ETF, let's bring this screen back up here. Again, it is 540.80 if you're over that level, all right? So that is your NASDAQ analysis. Let's quickly take a look at the IWM. Let's give this a little reset. There we go. So IWM has also been a pretty impressive performer on the Tuesday follow through in the upward direction. Remember that the main name of the game out of small caps right now is to continue to stay over this neckline of the inverted head and shoulders, which is also a micro inverted head and shoulders in the right shoulder. That level is at 209.75. Now, as we've talked about over the last couple of videos here on the channel, this has really developed into a balance range, and the balance certainly broke in the upward direction. So today's daily bar is much nastier than what we saw over in the S&P and the NASDAQ. You can see that here, down about 1.25% versus the 17 basis points and 13 basis points respectively in the NASDAQ and S&P. But where are we relative to the balance? As long as we're over 211.25, I would be hard-pressed to call that anything other than an opportunity for a higher low, right? We are pulling back from, at this point, maybe like a slightly lower high, maybe like an equal high, depending on how you want to classify it. You know, if you're going to be objective, of course, it's a lower high. But in the trend count, I would sort of call this an attempt at an equal high, especially if you consider this too, where the downtrend stopped here. If this is the top, the last lower high really, then this is a higher high. So you could get all sorts of nuanced about this, but I think the easiest way to approach the IWM is, are we over 211.25? And if that's the case, then I really don't see any reason to be an aggressive bear over in the S&P 500. So anything that looks like this, and then rotations back up towards these equal highs, bullish, probably looking for an all-time high in the S&P. If we get something that breaks down into the range, definitely more neutral and putting the long thesis on ice for the S&P somewhat. I wouldn't just totally abandon the long thesis in the S&P, but I'd be a little bit more neutral if your small caps do not hold up over 211.25. Why? Because, again, as we mentioned in the intro, one of the things that's been revealed over the last 2 days of Jerome Powell testimony is that basically the Fed has acknowledged if it wasn't for tariffs, then we would have already been cutting rates, and probably fairly aggressively. And if the tariff inflation does not show up, which so far it hasn't, they're still pretty adamant about end of summer to sort of get the data, so end of August, early September. But if it doesn't show up, which as of right now it's not, and the labor market's going to deteriorate, we'll talk more about this in a moment, but Jerome Powell is like, another thing that he made very clear is if AI is going to take away a majority of entry-level jobs for white-collar workers, obviously lowering rates should stimulate to some degree a little bit of the economy. So we'll see if that ends up being the case. And once again, small caps would be a huge beneficiary of that, noting how much they rely on the borrowing cost, or the cheaper borrowing costs improve their bottom line. Anyways, that's your conversation on the IWM, and that's your key watch here at 211.25. If we're above it, we look good, and it is a supportive, bullish piece of evidence for the S&P. If we're inside, it gets a little bit more neutral. I would only change my tone to being much more bearish if we're under 208.50, because at that point you've obliterated the potential hold of the weekly inverted head and shoulders neckline. What else? That's a lot. Let's take a look at the hourly chart. Let's see what's going on over here. Completely unwound, but once again, the concept here is Brigade Bolt. If we're over 211.25, hard pressed to be a bear. So we'll take this at face value as long as we're over the level. Still bullish. If we're underneath, as we've said, neutral. I've probably said that too many times now, so let's move along to the anchored VWAPs. And what do we see here? Confluence of support right around the key spot. So if we can hold it, you already know what I'm going to say. Let's take a look at our Russell market internals. We'll keep this show moving right along, and we'll see what we can see. So the volume outflow is not nearly as bad. So the S&P was really the worst offender on today's session. If you take a look at the advanced decline line, not in trend lower zone, but definitely negative, and very similar to the NQ, where the cumulative build on the tick, it was negative, but it was nothing substantial in terms of, oh my God, panic, look for the exit signs, markets are going to go to zero. Not the case here out of the internals. If we take a look at the market profile for the Rusty, Let's quickly get a sense for what's happening here. A little bit more of liquidation break off the open B-shaped profile. Point of control did migrate lower. The value area did migrate lower relative to the Tuesday session. So I would just reinforce the idea that if this breaches, then we sort of need to see support right here, right now. And on your RTY futures, you're probably talking about a key support point. You really wouldn't want to see it underneath 2147s. If you're underneath 2147s, you're sort of failing back down into the range a little bit more aggressively than I'd prefer. So you have a small window of opportunity here. If you can get back into the range from today, then please just understand as well, just like we can use this as overhead supply, if you snap underneath, come back in, and then break over these highs, anybody who's short the Russell after the liquidation break in A period, liquidation break just meaning this very thin structure breakdown off of the open, anybody who's short late to the party down here, we know there's like a majority of positions are held from this lower segment. If you break up and over 2163, give or take, you're probably squeezing straight back up to these highs. So 2182, and that of course would influence the S&P in which direction? Of course, in the upward direction. So watching that very closely here out of the Rusty. Let's move back over to the platform. Let's take a look through our sectors for the S&P 500. Let's make some assessments as to what the supporting evidence starts to look like. Bullish, bearish, edge. As you know, it's still bullish. So semiconductors lead the pack in terms of percentage performance, up 5.91%, followed by the XLK tech sector. XLF financials just behind, up 241 basis points. Really important and impressive that all of these sectors are outperforming the S&P, right? So those are basically all of those are your heavyweight risk-on sectors. As we look a little bit lower, the XLY would ideally be moving in the upward direction, but the thorn in the side of the XLY has to be Tesla at this point. We'll also talk Amazon in just a moment. At the bottom end of the barrel, it's energy getting completely obliterated, no pun intended, as of the resolution to the ceasefire in the Middle East. Seems to be like a fragile ceasefire, and we're sort of dancing on eggshells a little bit here, but if it persists, I mean, oil is back down to the unaffected price. We'll take a look at that chart in a moment, followed by real estate, consumer staples, and utilities. Now, what is a common thread between all of those? First of all, extremely lightweight sectors, and then secondly, partially defensive, right? Defensive specifically on real estate, staples, and utilities. Energy is more so just lightweight. So not concerned. As the market's breaking out here, it is being led by the heavyweight risk-on sectors. That is bullish for risk appetite, bullish for posture. If we take a look at some of these individual charts, I mean, how could you be bearish on the S&P as the semiconductors are having a massive breakout of a daily bull flag? Looks fantastic. NVIDIA's leading the charge. Broadcom's up there near all-time highs. AMD's been having one heck of a run. I mean, just really, really great looking stuff. Chart looks awesome. There's really two things that could happen here. Straight up continuation always takes care of itself. It maintains the bullish edge. If we do see a pullback, there's two spots. This previous pivot high and what was the bottom, or really the top of that gap, the low of this bar. At 270.35, we get a higher low for something that looks like this, or the top end of the flag breakout at 264.75. So no matter how you slice the cake here on the semiconductors, looks more bullish than bearish to me. And even if we do get a pullback, I think that the posture here, this is noteworthy. Please make note of this. The posture is in such a manner that if semiconductors pull back, I'm just going to skip around here for a second to the XLP as an example. Notice where we are here. We're at the bottom end of the balance range. If 80 is going to be supportive out of literally just the sideways consolidation and the XLP is going to bounce and the SMH pulls back, what does that mean? It means we're in a rotational market, which is bullish for the S&P. It keeps things afloat, and money keeps rotating from sector to sector to sector. And the only time the S&P aggressively sells off is when all 11 sectors are like, no, we're down. Sell everything. There's no safe spot. There's no place to hide. Everything's red. But from a technical perspective, if we get the 80 bounce on XLP, the pullback on SMH, or the pullback, let's just talk S&P sectors, on XLK, which FYI, massive brand new all-time high. If this pulls back to retest the all-time high for a Brigade bolt that looks like that, and as the pullback's unfolding from A to B here, XLP is moving higher, XLU is moving higher, again, you're in a rotational market. It doesn't mean that the S&P needs to move higher, but it means that the health is there in the underpinnings of the sectors that make it up. And so obviously just your retest levels here, 243.50 would be the gap close to the Monday high from this balance back here. All right, so bullish the XLK until proven otherwise. Financials, looks good. If you recall, we were somewhat concerned on Saturday about the potential for this as a double top under the neckline would have been concerning. Look at the Monday bar. Bullish engulfer. It sweeps underneath more than three, 1, 2, 3, 4, almost 5 days. It takes out the lows, supports the daily 50 at the neckline, and then closes where? Over the highs of 1, 2, 3, 4 days. So very bullish stuff out of the XLF. Again, very difficult to maintain any sort of bearish stance here. At the highs, I would be sort of open-minded to a pullback that closed the gap. It's definitely not blue sky territory breakout. Look at what we have in the XLK. But if we close this gap, what's the next idea? Can we set the higher low? Can we rotate to the equal high? And if we get the equal high after a higher low, that's where you look for it to break out. So really still looks constructive out of financials. Communications looks like a pullback is probably around the corner here. Look at that upper wick on the daily inverted hammer there at the all-time high test. To me, communications could easily break the previous candle's low, pull back here, close the gap, and then offer the same thing as financials. So ultimately a higher low in the trend count. But again, in the immediate time frame, in the immediate term, it does look a little bit ready for a pullback with that upper wick rejecting any acceptance outside of Tuesday's range, never mind the all-time high. So keep an eye out on communications for that. XLV, midpoint of its balance range, really not much to comment on over here. It's most constructive when it starts to make a new swing high or low. Let's take a look at discretionary. You can see I've got an alert here because I'm still interested in whether or not this is going to unfold. You're going to need a reprieve out of Tesla and Amazon if that is going to be the case. But for now, midpoint of the balance range, as long as we're in the balance range, I said this on Saturday, I would not front run the bearish breakdown to close the gap below. And the reason being is we know that the broad market has bullish context right now. So in theory, if this balance range is going to play out as a true balance, we should long the lows and we should sell the highs. Very simple, like go back to technical analysis 101 and let's see if we can, trade this as just a range. So if we approach the lows, can we find a bounce off the lows back to the highs? If we approach the highs, do we find mean reversion? And when and if the breakout occurs, we'll look for this to remain constructive for the broad market. What's another possible theory here? Well, if Tesla is finally going to get a little reprieve from its selling, and this is total speculation, I'm not saying this will happen, but play it out as a hypothetical, as a scenario, right? If that reprieve in the selling is enough to get the XLY to start looking like this, as the SMH is pulling back, as the XLK is pulling back, then what did we just sort of describe? Another instance of market rotation, where, as we know, that's bullish for the underpinnings of the S&P 500. So I'm really not seeing a huge reason to wrap up shop. Okay, sell everything. We made it back to the all-time high. Button it up. It's just down from here. I don't see it. I really don't see it yet. We would need massive trend reversals on a majority of different sectors and even just the broad market itself, and we're just not even close to that after printing a brand new higher high. XLI, pulling back a little bit from the all-time high. I think consolidation in here is fine. You maybe get a little bit of a look like a head and shoulders neckline would kind of be like that. I wouldn't front run it. I just generally think that this can cool off and consolidate in here. It's a little bit more meaningful for the S&P, about 8%. If you look at materials, definitely a failure back below. You can see the lower high here. Underneath that 87.60. If we take a look at the XHB for home builders, you can see I've got my alerts already preset for it. Remember that we have some tension here. Weekly double bottom needs the neckline to break here. Daily double top, which now, maybe someone's going to call it a triple top. You could even just call it a descending triangle, whatever. Underneath these lows, then fine. The sellers probably have a little bit more ammunition to say, all right, let's still refrain from trusting the S&P 500 at the all-time high. What does this represent? Much more of the cyclical side of the economy. One key question to ask and answer here, and I've got my own answer, and I'd invite you to leave some feedback on yours. Is the cyclical side of the economy, other than some might call it like the real economy to some degree, like hard assets, things that people own, right? You've got design, you've got build, you've got interior decorating, you've got all the different service businesses associated with new home builds, and then of course all just the actual goods. So there's a lot going on there, but as we think about what top companies comprise the S&P 500, it's all tech. So is this a little bit of an outdated signal or use, so to speak? I wouldn't go that far because, of course, you have mortgages tied to home builders to some degree, the strength of the American consumer. We don't need to go down the full rabbit hole, but all I would just sort of acknowledge here is I would not be so deathly afraid of the S&P 500 making a new high without the home builders and say, like, oh, God, I can't participate in this. Right? I wouldn't maintain that stance at all in the market. Anyways, let's move along here. TLT. Interest rates dribbling slowly lower as bonds creep slightly higher. No issues here. Let's take a look at, with the J-Pow commentary, I think that makes total sense. Energy mildly pulling back to its unaffected price. Here's like all the conflict freak out. We could go take a look at USO. You can see this as well. Here's the unaffected price. Here's things getting kind of heated up, if you will. If you take a look at CL, it's the same story. I've actually got a green box there. Yeah, there you go. So back down to the unaffected price, resolution being priced in, certainty back to the market, stability. The market likes that. Also, just on the inflation front, I would call out that it's hardly even going to amount to a one-time price shock on fuel at the pump or something like that. You might have had what, 1, 2, 3, like a week's worth of higher data. I don't think that that's going to translate to any meaningful inflation, if I'm being honest. So we shall see. But that's what I've got for you in my view of energy. Let's move along to real estate. The one thing I would watch out for on real estate, and perhaps this ties into the XHB conversation, as rates perhaps come down on the 10-year, you really don't want real estate breaking down. You want real estate maintaining sideways or even breaking in the upward direction as you get sort of the wealth effect coming back into play. Or if people are just totally sitting on the sidelines in cash, waiting for lower rates to buy homes, you want that to really show up in the actual mortgage demand, and real estate prices will reflect that. So I would be somewhat concerned if this had a more meaningful breakdown. If it was making new lows down here, I'd be like, okay, that's got to be a red flag. But for now, it's just not doing it. It's still inside of its balance range. So we'll continue to watch this with respect to interest rates coming down also. XLP, consumer staples, we already talked about it briefly, looking for the 80 bounce here for some sort of rotation. And then finally, utilities, same concept, bottom end of the balance range here. Brigade Bolt over the top end of 80.25. It's actually almost the same price point, looking to see if buyers can step up there off of the daily 50 SMA. It's not really a concern even if they don't. If we fall back into range here, not really stressing out about utilities, one of the lighter weight sectors, and as we know, a defensive sector also. Let's jump into our ratio grid and see what's happening from that perspective, risk on versus risk off. If you're not familiar with the ratios and how to set them up on Thinkorswim, check out the video tutorial in the top right-hand corner. XLK looks fantastic, printing a brand new higher high. Of course it will, with the actual all-time high in the XLK. The XLY has a lot to be desired here, and this, of course, stems purely from Tesla. Tesla's just been getting hammered on the downside after the Monday breakout. So we'll talk more about that in just a moment, but this leaves a lot to be desired in terms of signaling risk on. As we'll see in some other charts, though, it's not all hope is lost. XLF trying to perk up here, so could use some work. Let's go neutral on this. Let's put an X here. Healthcare deserves to be over here. These deserve to be swapped, basically. So what does this look like on communications as the fourth heaviest weight sector? Neutral to bullish. I'd give a small check mark being over the upward sloping 50 SMA. So all up, I would say you've got two checks, an X, and a neutral. Probably leans still more risk on. This is not signaling risk off. This is not signaling risk off. I still think that the buyers are in control from a posture perspective, as we've already mentioned. If we look at the actual specialized ratios, in the A set, we're checking 6 for 6. Even if you wanted to say this is a mild pullback, I mean, just go look at the ARC K itself. Come on. Hello. Is this bullish or is this bearish? I mean, anybody saying that this is bearish in terms of the trend, did we not just make a brand new higher high? So I think that the ARC K could certainly pull back. It could offer a higher low. All this would indicate to me is that, again, risk appetite is generally elevated right now. You're not going to see people rushing into some of these more risky technology companies in the ARC K if risk appetite was like, ooh, let's be defensive here. Let's really dial back what we're getting into, right? So that looks good. And once again, it's reflected here in the actual ratio itself. It's very nuanced, but it did technically make a higher high relative to this last one. So if this is going to be a double bottom reversal back in the upward direction, this is small cap growth versus small cap value. That is another bullish indication. So all of these all upward sloping 50 SMAs, risk appetite is increased. If we take a look at the B set, you can see gold falling off of a cliff on the resolution to the ceasefire. You can see that Bitcoin is back to firing a bullish Sailor Schiff ratio. I'd be interested in Bitcoin breaking out of this as a bull flag, perhaps, up and back into blue sky territories, basically. First target the all-time high at 112.275, but really seeking new highs after that if Bitcoin wants to get in gear. If there are going to be rate cuts, Bitcoin should be a beneficiary of not that rate cuts are directly a stimulation of higher liquidity. Excuse me, they're just lowering rates. There's a difference, right, between you could say like the money printer, basically, if you will. It's not the same as lowering rates. So I would not just directly say that liquidity is going to increase on rates being lowered, but generally the more accommodative policy should cause Bitcoin to move in the upward direction. Anyways, back to the charts in front of us. TLT ratio is not doing anything impressive. It's still sitting on these lows, which means elevated appetite for risk. Let's take a look at the dollar and interest rates dribbling mildly lower today on continued commentary from Jerome Powell that, hey, we're a little worried about the labor market and ultimately what's going to be in store, LAB, let's say, for labor market, and what's going to be in store with AI, taking all those white-collar jobs. If you can read the writing on the wall, right, as basically what's happened is the unemployment rate, if you were to think about I think it's called the beverage curve, something that looks like this, typically really low unemployment is associated with high job openings. You could think of job openings over here, jolts basically, and the unemployment rate. Let me just make this big. Why are we bothering with like a tiny little segment here? Let's do this. There we go. Look at that. You can actually see it now. So there's your beverage curve. This is job openings over here. This is the unemployment rate. Typically, high job openings is associated with a very low unemployment rate. High unemployment is associated with very low job openings. Well, as of right now, job openings are technically coming down, but the unemployment rate is not moving up. So Jerome Powell has mentioned this many times in his testimony and the FOMC press conference, honestly, the other day. And I think what this is basically forecasting is that rate cuts should be around the corner to combat against any potential flip or normalization of that curve, if you will. You'll notice that the inverted ZT, which is basically the 2-year yield, has been continuing to move in the downward direction, signaling that, yes, as this moves lower, technically the Fed funds rate should follow that. If we take a look at, let's actually just jump right into the Fed Watch tool. Let's jump over here. What you'll notice, and this is actually a big shift, is the market's now pricing in 3 cuts. 3 cuts for 2025. Remember just the other day, we were like, it seems like Powell and the Fed, based on the dot plot, wasn't even sure if we were going to get 1 rate cut into the end of 2025. Now look at this. 1, 2, 3. Market's pricing in 3 rate cuts. So very, very important to pick up on that. That obviously is one of the things that we talked about in the introduction. And lower rates should stimulate, once again, the small caps in particular, which would be a bullish supporting, like rising tides lift all boats for the S&P 500. Even for S&P companies, although they're flush with cash on those balance sheets, it just makes everything easier, lower rates. So that is something to pay attention to. The only counter argument here would be, well, hey, Matt, don't you think if the Fed's lowering rates, it's because the unemployment rate is going to get out of control, the American consumer is going to be broken, and oh my goodness, that's actually a sign that we should sell the market? It's historically that tends to be one of the things to think about. And then generally speaking, when does the market actually bottom? Well, when Jerome Powell starts turning the money printer back on and adding liquidity to the system. So I could see both arguments there. I would just say continue to watch the data on the jobless claims, and we'll actually get this tomorrow. If we take a look at the calendar, we're going to be getting the jobless claims at 8:30. We will have coffee and donuts up in the penthouse tomorrow. So 8 o'clock, come on out to the morning show. It's live right here on the channel, free and open to everybody. We'll watch out and see whether or not this breaks up and over 250. If it's over 250, then we have some concerns. If it's not over 250, then fine. Everything's status quo here on the labor market, right? If you look at this, we can all agree, right? Anything outside of 250 starts to indicate that we're out of the normal range. If we're under 250, all right, not so bad. Right? It has inherently been creeping higher over the last couple of reports, so we're keeping a very open mind to that. If the Fed is responding to, let's say, the spikes aggressively, we're at like 300, 350, then the next one 400, yeah, I don't think that the market is going to digest that all that well. So we'll keep an eye on it. That's continuing to be sort of the balance when it comes to the fundamental take here. Durable goods orders at the same time, GDP numbers, it's the final revision there, so it's not anything that the market shouldn't already have a good grasp on. I think that the jobless claims will be the top watch for tomorrow. Friday, PCE numbers, again, probably a nothing burger here. Market already has CPI as well as PPI. Let's take a look at the earnings calendar. Micron after the close here was higher last I looked. We can check in on it together. And then Nike tomorrow after the close will be important. FedEx recovered a majority of its gap down. So really no black swan as reported by FedEx. And honestly, the guidance there wasn't so bad. If we take a look at, let's go back over here, our remaining technical charts, we can see that the bond market is certainly pricing in the same idea as what we just talked about on the Fed Watch tool, where the shorter end of the curve is coming in a little bit, signaling rate cuts, whereas the longer end is still a little bit concerned about inflation. I would think that PCE could put that a little bit to bed here. Another thing that Jerome Powell consistently commented on, through the testimony at least, is the anchoring effect, so to speak, of the shelter side of inflation, right? The tariffs probably aren't going to impact prices of rent, for example, prices of mortgages, of course, at this point, given interest rates. So if that's going to anchor inflation, remember that shelter is roughly, my metric is typically about half. It depends on who you ask, but I typically round up. So CPI, it's about half is due to shelter. And if that's going to remain anchored, it's going to be very difficult for any inflation to show up from, number one, the energy shock just a couple days ago, and then number two, the tariff inflation. Probably, it might move a little bit. You're going to have to watch goods, really. And services is really where the sticky side of inflation is anyways, and that's what the Fed's been working on for the last year and a half or two. Let's take a look at some additional supporting evidence charts. Let's jump into the HYG junk bonds. You can see over here that this is confirming the breakout that we have in the S&P and the NASDAQ. This would indicate that risk appetite is strong. If you look at the LQD, it's not as aggressive as a breakout, but it is still moving in the upward direction. And that, of course, is bullish. I think we skipped credit spreads here, so let's just bring these up because it is important. We have a subtle divergence, which is kind of a head scratcher. The LQD is corporate grade, the HYG is junk bonds. So it's kind of interesting that the junk spread is tightening here, whereas the corporate grade is loosening and widening a little bit. You would think it would almost be the inverse, but I mean, if we're just taking this chart at face value, it would actually indicate that risk appetite is even stronger, right? Because investors aren't really demanding a bunch from HYG junk. They're not really seeing a bunch of risk of default, basically, which is kind of, I don't want to say crazy to think, because it's just, we're taking the chart at face value. Let's take a look back over here at the total breadth. This is another subtle concern. It's something that we'll call out. I'm not going to over-index on this, but as the market pulled back, right, and let's go ahead and what do we want? We want a daily chart down here too. So the market made this advance, right? And it definitely broke out over these prior highs. You could do something that looks like this, roughly, on some of these charts, right? Let's even put it on the green line. Did you get a new higher high on your 50 SMA? Did you get a new higher high on your 200 SMA? Did you get a new high out of new highs versus lows? The answer is technically no. So you're getting a little bit of concentration risk here. This is one of the only things I would say right now that poses a slightly more meaningful, I wouldn't even call it a risk at this point, but rather just an opportunity for a deeper pullback in the market. We can see this as well in something like the RSP, which has not broken out through these equal highs, right? If you look at this as a balance range, notice that we did not break through the equal highs versus in the S&P weighted, of course, we did move through those equal highs. So is it possible that the pullback could unfold? Could we try to find support down here? That to me seems like a reasonable outcome if you're just over-indexing on breadth. But based on all of the supporting evidence we've seen so far, as well as what I'll show you right now, volatility, collapsing, let's go VVIX in the same window, collapsing. If we look at volatility futures, stronger contango up here, stronger contango here on the 30 versus 9-day VIX. And check this one out, the lowest one-day VIX reading ever since really the entire tariff turmoil panic. So as I was saying just a moment ago, unless you over-index on the breadth issue of the market right now, everything else is pointing to improved risk appetite and really opportunities for a market rotation, which would maintain a bullish thesis here for the S&P 500. No major reason to get overly concerned about, oh my God, markets are going to crash and burn and go to zero. There's technical support underneath us, and there is supporting evidence, which suggests investors' optimism and risk appetite remains improved here relative to what we had not too long ago, really, Friday of last week. Let's take a look at the core list of companies. Let's see what's going on from this perspective, some trade ideas, and then you're on your way for the evening. Let's take a look. So on NVIDIA, we clearly broke out to a brand new all-time high. That, of course, has to be bullish. In the daily time scale and daily scheme of things, I mean, your picture-perfect pullback is something that looks like this on the daily chart. Are we going to get it? To be determined. If we were going to think about what's possible into the end of this week, there's really two things that I would watch out for. Anything that's just consolidating over 153.13, got to rock and roll up and over that previous day's high. So something that looks like this, Brigade bolt out of prior day's high, that gets bullish. Blue sky territories, $0.50 intraday levels that form. If we start to move underneath 153.13, I would not be short here. I would wait for this to turn into head and shoulders, and then possibly, if you dare, you might short NVIDIA under 152 for a scalp only to test the top of the gap at 149.25, possible gap close 148, and I would throw a huge asterisk on this and say only if the broad market is also pulling back. If the NASDAQ is still moving into blue sky territories, if the NASDAQ is holding up over its key levels, I would not force the issue on NVIDIA. I would just let it be unless there's massive confluence and it's a no-brainer. So those are your key levels, 153.13, 152. Then to the downside, it's this gap, blue sky territories above. Let's jump into Microsoft. Second heaviest weight company in the S&P these days. Just how can you be bearish on the chart? It's just been kind of like this freight train moving along in the upward direction, slow and steady. I would be pretty hesitant to say anything constructive about these daily bars. Back-to-back dojis at the highest high, the all-time high, doesn't really leave a lot to actually do as a day trade here. Maybe if there's a pullback to test the top of the range, you get a little bit of daily Brigade bolt over something like 482.25, 479.75, but I wouldn't force the issue. I would really be sort of like, from a swing perspective, from a long-term shares adding perspective, maybe, but as a day trade, I really don't love the chart structure here. So if it wants to provide this and it's a no-brainer, if there's easy risk reward, perhaps, but really a lower tier opportunity. Let's jump into Apple and see what's going on here. So Apple is this in the balance range, in the midpoint, nothing to really say. I think it's sort of a waste of time to try to trade Apple these days, but as still the third heaviest weight component of the S&P, got to keep track of where it is. So midpoint of the range, it's not really hurting the S&P. If it does make a new swing low underneath 193.75, that would be a little bit of a red flag. So we'll watch out for that, but nothing yet. Let's move along to Amazon. Amazon for the XLY continues to be a little bit of a drag. Let's just go straight to the hourly chart, because on the hourly chart, you can kind of see that we're kind of hanging out in no man's land here. Sure, a decent reaction today off of the 214.50, and shout out to anybody who caught that. But really, as of today's close, leaves a bit to be desired. I wouldn't want to be short underneath the 2-day low into this chop and slop, but I wouldn't really just want to be blindly long here either. So I don't see Amazon as like a no-brainer daily chart setup and like this is the next move on Amazon. Maybe if there's a recovery back over 214.50, we could try to trade it long closer to the highs, but I don't love the current location of the close. So unless there's something miraculous overnight, lower tier watch, kind of similar to Apple, similar to Microsoft, honestly. If we look at Google, Google's a better watch, and the reason being here is that you're still rejecting your daily 200 SMA. The idea to start thinking about on Google is sort of daily head and shoulders. We don't need to break the neckline on the daily just yet at 162.65, but if you take a look at the hourly chart, notice how this move was straight up. If this is going to get given back, it could happen overnight. So far, it looks like you're actually holding up a little bit more bullish, so let's not jinx that. But if this happens and we sort of open here and then Brigade bolt underneath 168.50, I would start thinking about Google shorts into something like your Tuesday low. That would be a possibility here. I think that you've gotten a little bit of a short squeeze off the daily 50, but now that you're rejecting the daily 200, Google has all the relative weakness. Everybody knows that the name of the game is AI search these days. It's no longer about the blue links. So I think, to me, this would be a reasonable opportunity to the downside should it present itself. Again, asterisk on needing a couple of things to happen first. You need to open over 168.50. You need to break under 168.50, offer a lower high, and then you're sort of targeting your Tuesday low. Okay, that's my view on Google. Let's take a look at Meta. Meta with a interesting daily breakout, right, of this. The reason I call it interesting is because on the Monday session, it was really straight higher, pullback, and then slow grind all day. And then on today's session, pulling back to the 705.50 again, little rebound into the close. If we take a look at the hourly chart, now you can see this as well. Look at your first upper wick on the hourly candle of Meta, basically the entire day's range. Today, mild pullback into the level, starting to support. If we can Brigade bolt over 711, I would start looking for 719. And this is just a very classic, right? You get the hourly Brigade bolt that looks like this. And to participate, you're really looking for like a 5 or a 2-minute Brigade bolt that looks like this. So it's all fractal, right? This higher low makes sense. It maintains the uptrend. And then we participate intraday over something like 711, which is your, you could sort of see that as your intraday previous resistance and then a little bit of support off the opening range today. All right, that's the metaverse. If it fails, so the alternative would be if you just get consolidation here and Brigade bolt under 705.50, it should probably be a short to the bottom end of the balance, indicating look above and fail, right? This is your failure to accept above, acceptance back below, targets the opposing end of balance. So that could also be a lucrative opportunity. Well, that would require absolutely asterisk here, only if the broad market's moving lower. Let's take a look at Tesla. Tesla failing back down into the range. Here it is on the daily, right? There's actually an interesting nuance on the daily. So if you look at this range and you look at this range, look at the overshoot here, look at the overshoot here. So I'd be very open-minded to Tesla rebounding back over 334 and then getting the rotation in the upward direction. If you take a look at this, it's pretty thin structure on the way down. So if we could get over 334, I think that there's easily air quotes around the term easily. It's easier as opposed to more difficult. It's a spectrum. It's not that trading is easy. But over 334, I would be looking for 344. Why? Thin structure retracement, right? So an easier opportunity relative to just like grinding around in this. Be my guest if you want to get chopped up in that previous chop and slop. So that's kind of it on Tesla. The other alternative would be if this immediately drives lower and can yield something along these lines, I would be interested in longing off of the daily 200, daily 50 down here with Confluence at 313.75. Moving along to JP Morgan, brand new all-time highs today. It looks bullish. The big banks, they're all firing on all cylinders. Looks good. Hard to be bearish the S&P when that's the situation. If we look at Netflix, swing traders probably have an opportunity to add here, almost similar to Microsoft in some sense, where if it pulls back to this previous high, then we would look to add around 1260. That would be, your classic Brigade bolt from this time scale. So we'll watch that for entries, but day trades, probably not. Swing trades only off of that 1260. Let's take a look at Palantir. A little disappointing today on the failure to really accept into blue sky territory, but nonetheless, we have this support underneath us. As long as we're over it, I wouldn't really maintain any short stance, but I just don't know. How should I frame it? The long doesn't really look attractive. It's very hard to long into an upper wick that looks something like that on Palantir's hourly. So neutral, just kind of neutral. I wouldn't take any sort of major short stance on Palantir, just sort of looking for that resolution of 140.75 over time. Let's take a look at Broadcom, brand new all-time high today. Mild grind. The idea here would be if it could stay in this range, Brigade bolts out of 267 get interesting for the upside. If it sort of does this and fails back below, I wouldn't short Broadcom there. I would be much more interested in saying, does it go gap fill reversal and then try a long off of this for a daily high or low somewhere around 253.75, right? So that is your core list of companies there with the graduates, the Palantir and AVGOs of the world. Speaking of the worlds, let's take a look at TSM as one of your ideas. You can see the alert. You can probably already guess the trade. If you get a pullback towards this 217.25, looking for longs off of that level, risk and reward back up to the equal high, to be determined if the pullback will ultimately unfold, but we will be waiting for it there. Another one to watch out for would be, speaking of semiconductors, AMD, of course, is one of these names that's been on a little bit of a tear here. Over 143.65 perhaps gets interesting. Next overhead level is up towards 147.75. And what else do we have? Shopify as a key watch here. Notice the recapture of this level here. It's got an inside bar on the daily. So if you look at the daily chart, you're inside. If you were to break the inside bar high, right, or even just you could use the container bar high, then there's possibly a trade here through some thin structure retracement. Over 114.75 after holding this as number one, producing an inside bar as evidence number two. If you get the intraday 5 or 2 minute Brigade bolt over 114.75, 117 acts as your target. We could go take a look at Reddit, RDDT, as another idea here. This is actually a short trade idea. Let's look at the daily chart first. If this consolidation is going to yield look above and fail, right, we are targeting the bottom end of the range. So ultimately on the hourly chart, if you're going to see some sort of small little rally out of the gates and reject 145, hypothetically, that's the full gap close, but really your target should be the bottom end of the range, closer to 132, let's go 35 on that. Round numbers only. You guys know the deal. Yellow always represents gaps on the chart, so let's just make this yellow down here as well, and then we'll keep this thing moving along. So I don't know, was that 4? I don't know if it was 4. I've got another one for you if you'd like. Of course, it could be on Coinbase. One thing I'll explain about Coinbase, which I think is a very important distinction, is Coinbase is moving because of the Genius Act, as well as the whole idea of the Circle IPO and generally the tokenization of assets. And Coinbase, you have to remember, is an exchange. It is not a proxy for crypto itself. It is a business. So because of that, Coinbase has massively outperformed your other, quote, proxy for crypto, which has to be MicroStrategy, MSTR. If you look at MicroStrategy, this is just like, hey guys, why'd you leave us in the dust? Why is Coinbase up here and MicroStrategy's down here? Because MicroStrategy is a leveraged Bitcoin play, which I think is an important distinction. Saylor has a bunch of Bitcoin on the balance sheet, but he does not make any money from the transactions on Bitcoin. Whereas Coinbase, if they're going to tokenize stocks, and you can trade the tokenized representation of stocks 24/7 based on sort of what's been paved forward with the Genius Act and all that, then think about the fees that Coinbase is going to rake in as an exchange. That is why this looks like this. That is why Circle looks like this, right? So I think that's an important distinction. And if we just go back to Coinbase for a second, if If we look at the hourly chart, the daily bar is pretty compelling for indecision up here. Any breaks of this low probably offer a thin structure retracement here. If the broad market is a short tomorrow, if the broad market pulls back, then 347.25 is a top watch for a lower high underneath, retracing down towards 319.75, which comes from a historic level off to the left. But really beyond that, it's actually probably closer to the opening print of that day, which is going to be closer to, let's just round down here, 313. All right, so I'm just going to go 313 on that level. And we will actually just diminish this one by a little bit by making it gray and dotted. All right, that's all I've got for you in today's episode of the Midweek Market Update. Hopefully you enjoyed it. We covered a lot. And honestly, what we've been doing in the live squawk almost every day after the close, every day this week at least, we've been doing this full style analysis with the live squawk members after market close every day. So if you're interested in this analysis daily, game planning for what is in play for different trade ideas the next day, and then the live market commentary as those plays are setting up and unfolding, feel free to check that out. It's the first link down below in the description. Some really awesome feedback from a bunch of the usual suspects around the channel for what has been an awesome first month. So outside of that, enough self-promotion. You guys get the idea. If you're interested, you know where to find it. If you enjoyed the video, none of this stuff is going to stop. We're always going to produce the Saturday, the Wednesday video, the live pre-market prep every single morning at 8 o'clock Eastern, kicking it off tomorrow with coffee and donuts for our GDP and jobless claims. We hope to see you there. Have yourself a green rest of the trading week. And as always, I will see you in the next one.